Hi, I'm Jimmy. In this video, we're looking at the current banking crisis, who could benefit from the situation that's been developing, what really happened to SVB. We're going to try to make that as simple as possible, and ultimately, how do we identify investments in the banking industry that aren't going to run into the same problems that they did. Now, in order to jump into the details of SVB, we should really understand the basics of banking financials in general. So we're going to run through some basics, then we'll look at SVB. For now, let's run through the basics of how we can analyze a bank. So like most companies, the balance sheet of a bank consists of two primary categories, assets and liabilities. But the assets for a bank are a little bit different than we might think. The primary asset, or one of the key assets for a bank, are loans. So if they were to make a loan to me or you, they were to give us our mortgage, that is a liability for us. We have to pay them back, but that is an asset for them. So loans are assets for them. The other big asset on their books is investments. Now, banks mostly invest in bonds, so although there are other possibilities, it's mostly bonds. Could be government bonds, could be mortgage-backed securities. It's going to be, likely, it's going to be a bond. And then on the liability side, well, the majority of liabilities for a bank are going to come in the form of deposits. So if a customer, if you or I make a deposit at our bank, that's an asset for us. We gave them money. That money is ours, but they owe us that money. That's a liability for them. So the bank's liabilities will be a deposit. This is going to be important as we go. But for now, we're going to focus predominantly on the investment part of this because this is very important to Silicon Valley Bank specifically. So we're going to look at the investment classifications that a bank and most companies typically have to do, but we're going to pay attention to how banks assign these categories. So there's three different classifications. When they buy an investment, they make an investment into a bond, they have to decide where it's going, how it's going to be classified. So the three classifications are held to maturity, available for sale, and trading. Now, they get assigned to this category by the company's decision. The company decides what is their intent. If they buy that bond and they intend on holding that bond, if it's a 5-year bond, they intend on holding it for 5 years, that would be classified as held to maturity. If they want it available, they're going to probably hold it for a while, but they're not sure. They want it to be, liquid enough that they could sell it if they had to. Well, that would be available for sale. If they plan on getting out of it tomorrow, they're just trading it perhaps for a quick profit, well, that would fall into the trading category. Now, when it comes to SVB, we can immediately eliminate trading since they don't have any balance sheet assets classified as trading. Bigger companies like JP Morgan, Goldman Sachs, Citigroup, they have big trading categories, and there's a ton of assets in there. Okay, now, held to maturity. Let's pretend that they buy a bond and they're going to hold it to maturity, so that's how they classify it. Well, that has an advantage of that number goes onto their books, goes onto the balance sheet, and the number doesn't really change all that much. If the value of that investment goes up, they don't get credit for it. If the value of the investment goes down, they don't get hurt for it. So that is one reason. If you didn't want as much volatility on your books, well, that is one reason to possibly classify them as held to maturity. Available for sale, well, available for sale do hit your books. Now, they don't hit profit like your typical earnings per share, but they do go in something called other comprehensive income. So if you didn't want your numbers to look all that volatile, what you could do is put more in held to maturity and less in available for sale. Trading, on the other hand, the final category, again, doesn't really apply to SVB, but if you're curious, trading, if the value of it goes up, you get a credit on your income statement. It goes straight to profit. If value goes down, you lose, that amount directly on your income statement. Big banks do a lot of it, less so for a bank like SVB. Okay, so we're going to come back to this, and I just want everybody to have the baseline for how this works. The final piece that we have to understand is how interest rates work and ultimately how the pricing of bonds work. So the most important thing for us to understand about interest rates and bond prices is that they're inversely related. If interest rates go up, the price of the bond will go down, and the same is true vice versa. So We have to keep that in the back of our mind, especially since we're probably fairly aware that interest rates have gone up and are likely to continue to go up. But we're going to wrap back to that in a second. For now, let's jump into SVB and look at what happened there. So as we can see on their chart here, well, the stock was up near 600 and now it's down, according to the most recent trade, about $100 per share. But this stock got halted a few days ago, so it's likely that this is going to get a whole lot worse for anybody still holding this stock. Okay, now let's jump over to some of their numbers. Now, we looked at the classifications. In their financial statements, we went back quarterly for all the financial statements, and we pulled down how much in assets they had in available for sale investments. And we can see they had a decent amount. They had about $30 billion in available for sale. Okay, now let's jump over to held to maturity. So when we look at held to maturity investments, we kept the scale the same here. We can see that they have way more held to maturity investments. That's interesting. They took on a ton of assets over the past couple years. But the thing that actually interests me the most is we can see it better when we overlay interest rates. So this is the Fed funds rate. The red line is the Fed funds rate. The Fed funds rate is the interest rate that the government sets. But look at where the majority of their purchases happened. So assets, deposits were coming into the bank, liabilities for them. They're taking those deposits and they are ultimately investing it. But because we saw the seesaw and we know that interest rates and bond prices are inversely related, well, when interest rates were at the lowest they've been in history, they're buying bonds means that they're paying top dollar for these bonds. So to get a better look at how they've ultimately classified the assets that they have, well, we put the two charts side by side, and we can see that their held to maturity assets dominate their available for sale assets. This is very, very important because held to maturity assets are being held to maturity. They can't access those at this point. If they need it, if there was ever, let's say, a run on the bank, they can't get to those assets. They're illiquid. By classifying them, which was, again, their decision, by classifying that as held to maturity, that money gets locked up. Now, we might ask the question, are all banks doing the same thing? Sure, some banks, I'm sure, are adding some to held to maturity, but when we pull down the numbers for another regional bank, well, now we can look at Citizens Bank. This is Citizens Bank going back the same time period to a different scale. Sure, the Citizens Bank is slightly smaller, but we can see that they're available for sale. They're liquid assets, assets that they can get to quickly, dominate their held to maturity. Now, we might notice down here with the blue lines that the blue lines do, in fact, see a jump. In fact, let's isolate just the blue lines. We can see that the blue lines did see a jump in the past 3 quarters. But when we overlay the interest rates like we did for SVB, well, it looks like they made their biggest purchases when interest rates started climbing, which is much, much smarter because they're going to have smaller unrealized losses than SVB's really going to have. So just to make things a little bit easier to compare, let's look at the two charts side by side. So we can see SVB has their held to maturity, the blue lines, dominate the orange lines, the available for sale. Don't forget, blue line, held to maturity, not liquid. They can't get to that money. The orange line, in the case of Citizens, well, Citizens, the orange line dominates the blue line. Again, the orange line, they can get to those assets. Now, this is important when we consider some of their financial ratios. One of the most important financial ratios for a bank is their Tier 1 capital ratio. Now, according to their own financial statements, the required Tier 1 capital ratio for SVB is 6%. By the way, higher is better. Well, their current Tier 1 capital ratio comes in at 15.1%. So we can see that they more than cover the 6%. But it's important that we know how this is calculated to understand the impact of the decisions made that led to the current problems. So first we have their Tier 1 capital. We can see that they have about $17.5 billion. This is according to the most recent annual report, which ended just a couple months ago. $17.5 billion. By the way, if you're wondering, Tier 1 capital is their their premium, the most liquid capital, the capital that if depositors came to for it and they needed it, they could get to it real quick, right? Their premium capital. Well, you divide that by the risk-weighted assets of the company. Their risk-weighted assets are about $113 billion. If you're curious, that's where the 15.1% came from. 17.5 divided by 113, you get to about 15.1%. But here's the important part. Their Tier 1 capital does not include the held-to-maturity losses that they've already incurred. Well, on their books, again in their financial statements, we can see that they have losses of about $15.1 billion. These are held-to-maturity losses. Why would they be losing money? Because they bought the bonds at the worst possible time. Well, with those new numbers, if you were to take that 17.5 billion, subtract the 15.1 billion losses that they have, which by the way, they would have to do if those assets were not classified as held to maturity, they were classified as available for sale, and hence would have access to it. Well, if that was the math, their new Tier 1 capital ratio would be just 2.1%, which at least partially explains why they didn't classify a lot of it as available for sale. But when we jump back to the chart on the two classifications of their assets, the real problem here is the company willingly locked up this capital. Held to maturity is not an assignment that is based on some rules. You could buy a 10-year bond and make it available for sale. You could do all sorts. The company gets to decide how they classify this. And to make this worse, in their financial statements, in the most recent annual report, they talked about they had the option to move money from the classification of held to maturity to available for sale. But if they did, the loss that those stocks, those bonds had already incurred would ultimately be shown. So they opted not to do it. That wasn't that long ago that they had that choice and they didn't do it, which means they chose to keep their money locked up. This is important because the problem with the SVB is that they're illiquid. If we consider a situation like FTX and that whole crypto debacle that happened, they were insolvent. Insolvent means the money was gone. They didn't have the money. They used the money. In their case, they lost the money in trading or whatever happened over there. Customers made deposits. That money was gone and they spent it somewhere else. That is not the situation with SVB. SVB has the money. They just locked it up. They decided to lock it up, which also explains, if you've heard the stories about how the FDIC has stepped in and ultimately guaranteed the deposits. Well, the FDIC, they can sell these assets. They've taken over the company. They can sell off the assets. The assets are there. The company's money's there. The company just locked themselves out of it on purpose to make their numbers look better. To me, this is borderline criminal. This brings us to the question, are there opportunities in the banking industry? And I believe that there's going to be many opportunities in the banking industry. The key is look at the ratios, see what the better ratios look like, but then look closer at the numbers. Make sure we analyze it a bit more. Look at how much they have tied up in held to maturity. And we have to know that held to maturity money is not accessible. If we're looking at some of the big banks, who I think are more likely to be some of the beneficiaries, they should be able to buy some of these assets from the FDIC and whatever other government agencies are going to start hawking this business. They should be able to buy some assets that seem to be worth a decent amount. They probably get a pretty good deal. So the bigger banks probably will do fairly well. But also pay attention to the bigger banks' numbers. We don't want to get caught up over there either. So I think that there are plenty of good opportunities in the banking industry if we're willing to dive a little bit deeper. Now, we actually did a much longer live stream for our private investing community where we went through the banks and we talked about different opportunities. So if you're curious, you'd like to get access to the private investing community, I will leave a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.